Hello, this is a video about my website on financial education. I'm just showing my webcam briefly, and I'll talk about a quiz that I wrote to assess your financial knowledge and what each question means. I'm going to share my screen. So this website I've called Tippyfi. It's named after this orange cat, my girlfriend's cat. And the idea is to make it more common for Americans to achieve financial independence, which sounds kind of vague at first, but it's actually a specific term, meaning that you're able to live off of your invested money without having to earn any new money, unless you choose to earn new money. So that requires having about 9,000 times your daily expenses, or 300 times your monthly expenses, or 25 times your annual expenses accumulated. So if you have, let's say, $1 million in the stock market, you should be able to live on that if your expenses are about $40,000 per year or below without having to work anymore. So obviously most Americans are nowhere close to this goal. In fact, most of them probably don't even have a few $1,000s saved for an emergency. So that's a big problem we've been working on in financial education and financial literacy research spaces for a long time. Unfortunately, it hasn't gotten any better, at least in the past decade, according to survey research. And most courses that are offered in high school don't seem to change behavior much, although there is some new research coming about that if it's targeted, if that course is given to be really relevant to the learner at a specific time when they need it, like right before they're going to get a mortgage or a student loan, then that could be more useful. So this is a quiz that I wrote. It's not really something that I consulted with any research for, but just my personal knowledge of finance. Now, a lot of it overlaps with mathematical knowledge, especially calculating percentages. So with this first question, which you can access if you go to my website at this URL or on the homepage, tippyfi.com, asks about depositing $1,000 in a savings account that has a 1% annual percentage yield. And then I clarify what that means, that the balance is going to grow by 1% year over year, and then ask how much will be in the account after 2 years. So right off the top of your head, you might think, well, $1,000 divided by 100 to get to 1% is $10, so it's going to be 1,020. But then you have to consider that in the second year, the account is growing from what the balance was not at the beginning, but what it was at the beginning of the second year. So that's why it's slightly more than that. So if you were to go just to Google, you could do this by doing something like this: 1,000 times 1.01 times 1.01 again. And so that would be what would get you to that amount. So it actually grows an extra 10 cents than it would if it was linear compounding. Like if we put root 2, to the second power, that would be the same. So if you were going to look at after 10 years, you would just put a caret by hitting shift plus F, not shift, but shift plus 6, and then 10. And then after 10 years, by simple math, you'd think it'd be 1,100, but by compound, you'd have an extra $4.62 in 10 years. So that's why the answer in that one is this option. And this is just obviously not a good response, but it's there if I was going to use this to actually test people's knowledge to eliminate a guessing effect. If they picked that one, I know they didn't just guess. When a person earns money, they pay 10% as tithes to their church. Pretend that no other expenses are in play here. And for this person to be able to buy a $100 item, how much do they have to earn? So bear in mind, they have to pay 10% tithing on the total amount they earn. So it's not just $110, because if you were to say take $110 and give 10% to the church, then you would be giving $11 to the church, leaving you with only $99. We could see that if we were to put in 110 times 0.9. So the actual way to compute it is a division operation where you divide 100 by 0.9. And then you'll see it's 111.11. And so that's why they have to earn that much just to get $100 left over after tithing. So this is important when you consider your tax rate and you're paying maybe state income tax if you live in California or New York or another state like that, and you're paying federal income tax, you're paying Medicare and Social Security tax. So if you buy something that's $100, you might actually have to earn $200 to pay for that. If 5 people have the winning number in a lottery and the prize is $2 million, how much will each of them get? And this is assuming it's just a simple math problem. It's split evenly, and don't even think about taxes, and don't even think about like getting a yearly, like 30-year payout versus lump sum. And this is actually a question that I adapted from the Health and Retirement Study 2004 version. And a lot of people get this wrong according to that study. And so I changed it a little bit. But anyway, for this, you would just take, let's just say 2 million and then divide it by 5. And so then you'd see the answer is 400,000. And so that would be that one. Suppose you have a credit card and charges you 24% annual percentage rate on purchase, compounded daily from the date of the purchase. And then I even explained this here. This means each day the amount owed is 100.06575% of what was owed the day before. 1 year after a purchase is made, how much of the original amount will be owed? Assuming that there are no payments and no late penalties. I know it's a little contrived because credit cards always have a minimum monthly payment, but if you were to be charging more to that card and paying the same amount of the additional charges, that would happen, because usually people get in a cycle of credit card debt where they never fully pay it off, and they're making new charges, all of which start collecting interest for the credit card issuer the day after the charge. So here you might think it's like, oh, it's 124%. But actually, because of that daily compounding, it's 127.11%. That's the APY. 27.11% is the APY, annual percentage yield, to the credit card issuer with a 24% APR compounded daily. So you notice with savings accounts, like banks always say like their APY is like 1.6%, right? And so that APY it sounds better than the APR, because the APR is actually probably only like 1.58% or 1.57 or something like that. And when you have a bank account, they usually compound it monthly, whereas a credit card is compounded daily, which is worse because you're paying higher interest in. If your savings account was compounded daily, that would be better for you because you'd be receiving more interest. But when your credit card is compounded daily, that's worse for you because you're paying more interest. It's worse for you, better for the credit card issuer. The math behind this would be something like, let's say we've got $100, and then we might want to times that by, it's always hard to remember this when you're like on the spot making a video. But let's say we were to take like the figure I gave here and move the decimal point over to the left 2 places. So that would be like floating point, moving it 2 places over. And then I think you can do root 360, not root exponent 365. Yeah, so that would give us 127.11 by taking that and raising that to the 365th power to account for that daily compounding. And of course, this is covered in college algebra or high school algebra, as well as the PERT equation for exponential compounding, which uses the mathematical constant E. And of course, nobody, I don't think, uses exponential compounding in finance. So you would have the other equation for a time-based compounding, where it's compounded 365 times per year. If inflation increases prices by 2% per year for a given item that currently costs $100, how much will this item cost in 10 years? Of course, that's in nominal dollars, not inflation-adjusted dollars, because if you were adjusting for inflation in 10 years, it would cost the same. So we're looking at the number of dollars needed in 10 years. And this could apply to any currency. It could be US dollars, it could be a different country's dollars. If their inflation rate was 2% every year, which is an APY, annual percentage yield, well, sort of like an APY. But anyway, the straight answer, if it was just one-time compounding, would be 120. But because it's on an annual basis, it's more than that. So you would actually need to take 100 and then multiply it by 1.02 to the 10th power. And so then you'll see it's 121.90 approximately when you round to the nearest cent. You are shopping at a clothing store in a clearance section, and all the items are 50% off the marked prices. If it has a yellow tag, you get another 30% off. What method of computing the discounted price would result in a lower price for the customer? Reduce the marked price by 50% and then reduce the new price by an additional 30%. Or sum the two percentage discounts, 80%, and then reduce the marked price by 80%, the sum of the two percentages. So the answer is this one, because if, let's say the item is just $100 for simplicity's sake, if you take 80% off of 100, you get $20. But if you take 50% off, you get $50. And then if you take 30% off that, you get 30% less than $50, which is $35, not $20. So when you take the 50% off first, this 30% has the effect of only taking 15% off the original price. So this is less advantageous for the consumer and more advantageous for the clothing store, where summing the two before you take any discount is better for the customer. Over a 30-year time frame beginning now, which of these is most likely to be the most profitable investment? A CD, a mutual fund of the S&P 500, which are about the largest 500 U.S. Companies by market capitalization, largest public companies, a 30-year United States Treasury bond. So the highest yield is going to be from the stock market, especially over 30 years, because then over that long period of time, you're pretty much guaranteed to make money, and more money than you would in these two other options. If you were looking at any one particular year, then the mutual fund of the 500 stocks would probably only outperform these two in maybe 70% of the time, maybe 75, somewhere around that. But if you're looking at that long time frame, then it's definitely going to be this one. And then second would be a treasury bond, usually higher than a CD, especially a 30-year one, because your money's tied up that long unless you want to take a penalty. And then, well, a CD kind of depends too on the length of time. So that could be a high interest rate, relatively high if it's a longer CD, because there's a penalty for earlier withdrawal. But these equities are going to be better in the long run. And that's a mutual fund of large cap stocks. If you were going to pick like an individual stock or even a whole sector, that would be less guaranteed. Doing the whole U.S. stock market is better, and probably some people say the whole world stock market might be even better than just the U.S. stock market. Of course, the 500 companies are just the largest ones, and then there's a few thousand other rather large companies, like publicly listed companies, you could also invest in using a broader index fund. 8, avoiding income tax is a reason to contribute to an individual retirement arrangement. And so that's true. There's a difference between avoiding and evading income tax. And so avoiding is lawful and evading is unlawful, illegal. So individual retirement arrangement is a political device created by the United States Congress to reduce people's income tax burden if they contribute to it. And a lot of people think the A stands for account, but in the law it doesn't. It stands for arrangement, not for account. It's not an individual retirement account. It's an arrangement. And what you do then is you can put money in there each year if you have earned income, and if your income's below a certain amount, it's about, I think, about $200,000 a year for married couples now. If your income between the two of you is above that, you can't contribute. And so that money can be either taxed now and not taxed in retirement, or it could be taxed later but not taxed now. Monies contribute to IRAs, 401ks, and 403bs, which are the nonprofit equivalent of a 401k for teachers, for example. These monies can be invested in CDs, money market accounts, and fixed income assets like bonds, but cannot be invested in equities. So that's false. You can actually invest any of these accounts in stocks. And they're really just wrappers for whatever you want to invest in generally. Now, sometimes you'll be limited by your choices in your 401k of what you can invest in, but it's actually becoming very common to have the option of investing not just in stocks, but in a fund that has low expenses and doesn't pick a market sector or anything like that, but just invest in the whole US stock market, which is more safe and better overall. You probably are going to lose money if you try to pick stocks, or at least you're going to make less money than you would have had you not picked stocks and just invested in the whole market for the long term. In a 10-year period, which of the following earning scenarios will result in an unmarried individual paying less money in U.S. federal income taxes? Earning $500,000 in one of the 10 years, but earning zero in each of the other 9 years, or earning $50,000 in each of the 10 years? The correct answer is spreading the income out over 10 years. And so if you look up like the tax brackets, you'll see that is true. The reason is it's based on a year-to-year basis, and your income gets taxed at a higher rate as you go up. Some people don't understand, though, that they think that when you go up to a higher tax bracket, that all of your income is taxed at that rate. That belief is 100% incorrect. In fact, your income is taxed in each of these brackets in a stepwise fashion. So if you make, let's say, $500,000 in 1 year, then your first $9,325 of taxable income as a single person is taxed at 10%. After your deductions, which you would take the standard personal deduction, and that would be not taxed at all. And then the next portion from this amount to $38,000 approximately gets taxed at 15%, and then the amount from $38,000 to $91,900. So that's just a portion of your income amounting to $53,949. Those $53,949 are taxed at 25% federal income tax. And then these approximately $100,000 are taxed at 28%. And then the next like $225,000 are taxed at 33%. And then the next only like $1,700. It's kind of weird that the new tax law has this tiny little tax bracket, but those $1,700 between these amounts are taxed at 35%, and then the rest is taxed at 39.6%. So that's why it's actually better to spread out your income over multiple years. And so I've actually called that for college graduates the late start disadvantage, because when they're in college, they're usually earning less money. And so they might earn less money in the beginning and then higher income later. And so that actually results in them having more income taxes, a higher effective tax rate, because their income was concentrated in later years rather than being spread out over more years. 11, given the performance of stocks in the past, U.S. stocks, if one invests in an in an index mutual fund of the whole market, U.S. market, the probability of making money in any one particular year period, 1 year period, is approximately what? It's about 75%. I put 1 year period because it could be any period, basically. But even if it was like January to December, it would still be about the same. Or it could be like February to January or June to May if you wanted. So in any year, you'll probably lose money 25% of the time and make money 75% of the time. But the higher the number of years, it gets closer and closer to 100%. And that leads us to the next question, which I already answered just now. Given the performance of U.S. stocks in the past, if one invests in an index mutual fund of the whole U.S. stock market, as the number of years one stays invested increases, the probability of making money gets closer and closer to 100%. That is true. Now, that is in comparison to the principal, the balance that was first invested. Now, if you were to look at the starting balance on any one particular year and the ending balance at the end of that year, the probability that it increases is probably about only 75%. But when we compare it to all the way at like year 0, when you're in year 30 or year 40, you're 100%, approximately 100% probability of having a higher balance, even when adjusting for inflation, because U.S. stocks outpace inflation. They return higher yield than inflation. 13. If one has plenty of money saved, it is generally a good idea to purchase insurance that protects against minor expenses. So contrary to insurance salespeople and to what you might see when you try to book like a flight or something where they'll say, oh, you need trip insurance, this is actually false. And the reason they're trying to sell you trip insurance and stuff like that is just to make money. It's a money-losing proposition for you. It's the same thing when you go to a store like Best Buy and they try to sell you a Square Trade warranty. The way Square Trade makes money is they take in more money in insurance premiums than they pay out. So that means that if you have plenty of money saved, you should not insure yourself against these minor expenses, because overall you're going to lose money. If you were to say insure yourself 1,000 times for 1,000 expenses, you'd be guaranteed to lose money. It's the same principle of going to a casino and gambling a lot or buying a lot of lottery tickets. The more you do it, the closer and closer your probability of making money gets to 0%, and the house's probability goes to 100%. It's called a central limit theorem, if I remember correctly. It's a mathematical principle. 14. In most U.S. states, giving a person durable power of attorney means they can make medical decisions for you if you're incapacitated, even if their decisions are contrary to your family's wishes. Now, this might not seem like a financial literacy question, but financial literacy is an eclectic field. It encompasses many other things. It's very general and all-encompassing, and it touches every area of your life. So this is actually true, and sometimes people find this out the hard way. If a certain family member has it and they want to make a decision that's not the best decision, but they have the authority and the other members don't have a say, or if an attorney is given power of attorney, and in this context, durable power of attorney means a different thing than an attorney who practices law. So someone who's not a lawyer or attorney could have a durable power of attorney, like you could give it to your son or something. If they give their attorney the power of attorney, then the attorney could even decide that, oh, the family's not allowed to visit the sick person in the hospital, and the family is actually unable to do anything legally. So that's very important to know the law on this, especially as you get older or as your loved one gets older, and to have contingency plan for this. Generally, designating someone as a payable on death beneficiary of a bank or investment account supersedes or bypasses beneficiaries' names in a will. So this is actually true, and what that means is sometimes you might have the will and think that you're going to inherit money, but then you could find out after your parent or grandparent passes away, or aunt or uncle passes away, that they name someone else on the account, and that actually overrides what's in the will, and the money will go to that person that's a POD, payable on death beneficiary, instead. So this can be beneficial, especially if you don't have a will and for some reason you don't write a will. The payable on death will actually bypass probate, and there are some estate tax implications too, which you would want to definitely have a competent financial advisor or financial planner or estate tax expert review your plan, especially if you have significant assets. So keep that in mind. The will is not supreme because payable on death can override that, and a lot of banks let you set who is payable on death even in online banking. So someone could just go on there if they have access, or the account holder could go on there and change the payable on death beneficiary, overriding what they have in their will. 16. A downside of health insurance is that hospitals typically negotiate higher rates with insurance companies than what they would bill an individual who did not have health insurance. A lot of the time, if you don't have insurance, you'll get a whopping bill, but if you have insurance, the rate's actually lower because they negotiate a lower rate with the hospital. So this is false. People who are uninsured get a whopping higher bill using what's called charge master pricing, and this is a pricing system that hardly anyone pays, and it really accounts for the percentage of unpaid accounts that hospitals and other practitioners have. So if you say like a hospital only gets paid like 15% of the time, then their charge master pricing might be 6 or 7 times the actual price that like an insurance company would pay. And sometimes that's a little bit lower the ratio, but having the insurance alone actually lowers your cost. So what will happen is just because you have the insurance, what you get charged is less. Even if you have a high deductible health plan where you're not eligible to use the insurance until you pay like $14,000 a year, that insurance will still benefit you because you'll get that lower negotiated rate. So that's a hidden benefit that a lot of people don't actually know about of having health insurance. 17. A disadvantage of accumulating an emergency fund is that you may become ineligible for means-tested benefits such as SSI, Supplemental Security Income. So this is actually true, and what it means is you can't accumulate assets. For people with a bipolar disorder or a physical ailment, they have to have less than $2,000 if they're single, or less than $3,000 if they're married in assets. And assets counts your money in the bank. If you have a second car, they might even count that. If you have investments, they'll count that. So that means that if you were to go above $2,000 or $3,000, instead of getting like $721 for an individual, that was the rate in 2014, or $1,100 for a couple, you would get zero. And so that's why it's difficult to accumulate any assets if you're on SSI, because if you do, the penalty is extreme, because this benefit that you're getting each month just totally goes to zero. They do have programs, I think, in certain states for people to be able to save to get a car, or maybe for other purposes, but it's kind of complex. And of course, a lot of SSI recipients hide money under their mattress or something like that if they're saving money, although that is illegal and cannot be. I cannot recommend that. I can't recommend someone to do something illegal. So 18. Overall, the distributions of income and wealth in the U.S. have both been becoming more equitable, meaning like more fair and more evenly distributed, since the 1970s. This is false. Actually, there's more inequality now than there has been since the Great Depression, or maybe even further back in history. And mainly that's because of the top 0.1% of people in income and wealth. Those are the people who are like way ahead of the other 99.9% right now. And they've been getting more and more ahead over the past 4 decades or 5 decades. And so actually with wealth, the distribution of income is a little bit more equitable, but the distribution of wealth is even more inequitable than the distribution of income, because people who are wealthy tend to accumulate more and more wealth, where people with lower income tend to have their net worth just stays flat. They never get like anywhere toward financial independence. 19. Dollar for dollar basis, without considering taxes, funds acquired through hard work and funds acquired via a windfall, for example, winning the lottery, of equal value. So this is a psychological bias that I've painted in explicit terms here. And so you read this and you know right away, obviously, without consideration of taxes, of course, the funds, once you have the money, even if you got it for free, it still has the same value. So they're of equal value. And what that really means is, if you got the money easily, you shouldn't treat it differently than money that you earned hard. It shouldn't be easy come, easy go. Because although that money might have come to you easier, it's not worth any less than money that came to you through hard work. So that's why you really have to internalize that if you're making a lot of money and letting it slip through your fingers, or if you've come into a windfall. Otherwise, you think, oh, this is great. I have tons of money. I'm going to go out and buy a Ferrari, or I'm going to go out and stay at a 5-star hotel. And then before you know it, you've depleted those funds and you're back to living paycheck to paycheck. So number 20, this is a long one. Which of the following has a positive impact on your credit scores? And notice scores is plural because everyone has multiple credit scores. you have one from Equifax, one from Experian, and one from TransUnion, assuming you have enough credit history to have a credit score. And then there's even other scores, like maybe your Clue score from LexisNexis, credit. Something called check systems for opening a checking or savings account. They have a score on you as well, and these can actually differ. And then there's even composite scores of all three that might be computed by, say, a mortgage issuer. If you're going to get a mortgage, they're going to pull all three credit bureaus, and they're going to consider your income as well and your assets. But if you're applying for a credit card or bank card, they're just going to pull maybe from one or two bureaus, or sometimes three bureaus, like Capital One. If you apply for one of their cards, they'll pull from all three: Experian, Equifax, and TransUnion. But then a lot of card issuers just inquire with one of the credit bureaus. So that can be a source of different credit scores. You could have a different score with Equifax because maybe all the cards you applied for pulled from Equifax, and that lowers your score if you have more inquiries. And then your TransUnion score might be higher, or vice versa. And then here I'm trying to address that a lot of these things people believe help their score don't actually do anything for your credit score. So being more than 90 days late has a negative impact, so it's not that one. Your credit account being 90% of your credit line is bad, because if you look up the factors in your credit score, one of them is utilization, and what that means is using a small portion of your credit line is better, and that's here referred to as amounts owed. So generally, it's easy to remember because it's 30% of your score, and having less than 30% of your credit line used is better than having more than 30%. So having 90% is going to lower your credit score a lot, but then if you were to pay that down to be lower than 30%, your credit score would go up pretty quickly. Like as soon as that new amount is reported to the credit bureaus, which is usually every month on the statement date usually, then your credit score might jump up like 60 points as soon as that went down quite a bit if you paid it off or paid it down to below 30% of the credit line. All your credit accounts being opened within the past year is bad because you have more inquiries and your average age of account is lower. So that negatively affects new credit, because new credit means your credit score goes down if you have more new credit. As the credit gets older, your score goes up. And then length of credit history, longer is better. And so they look at each account and like average all of the accounts together. And also they look at the oldest account, and having an oldest account is good. So that's why it's good to start your credit early. Having a jumbo mortgage on its own, it doesn't have a positive impact on your credit score at all. It might impact you negatively in some ways, actually, because they'll say you have too much credit extended, although the mortgage is considered safe because they have collateral. They can always take the house back, or townhouse, or whatever it is, or condo. But you know, after like 2008, when they had the housing bubble collapsed, there's more fear from lenders about that happening again. A lot of it, as of June 2018, when I'm recording this, has eased up, so it could be easier to get a big mortgage now than it was in 2009 or 10. But it's still it doesn't really help your credit score per se. Having two or more different types of credit, I'll just tell you now that's the answer, because that's one of the things here where it says credit mix. That improves your credit. So all you have are credit cards. Your credit score like might never get above like 790 or something like that. But to get up to the maximum, which is 850 with most of the credit scores, you might need to have that credit mix. And of course, you're going to need a long credit history and 100% good payment history and low utilization, etc. So that's the answer. Now we'll talk about the other choices. Paying your storage units bill on time each and every month doesn't help, but if you don't pay it, they might send it to collections and it'll hurt your credit. So stuff like your utility bills and your storage unit and your rent, it can only hurt your credit if it gets sent to collections and it goes as a derogatory mark, but it doesn't help your credit if you pay them on time. Now there is a new limited exception to this. It's called credit score for people with no credit score, basically. I forget what it's called exactly. And then I'll put in like a utility bills, came out not too long ago. So this is a new FICO score that came out in 2015 approximately, or at least became like widely used or known then. And so it was made by FICO Fair Corporation. Let's see if I can remove this ad and end this ad. And so what this does, it's a scoring method for people who don't have a credit score because their credit history is too thin, like they don't have credit cards, student loans, mortgages, or auto loans. And so then the credit issuer has an alternate way where they look at your mobile, landline, cable bills, and maybe even like how long you stayed at the same mailing address. And being at the same mailing address longer is better. So then this might be used for like the 53 million unscorable people in the United States. It's used in about 15 million of them, possibly. I don't know how that's gone since this was published 3 years ago. But anyway, it can affect your credit. But once you have a credit score from having those trade lines like credit cards or auto loan, student loan, or mortgage, then they don't use this one anymore. They use your regular credit score. The high net worth doesn't impact your credit scores, except maybe your check system score, because they have like a 1 to 6 scale on evidence of assets, and that could benefit your check system score, but that only applies to opening a deposit account, bank, checking, or savings. It doesn't help your credit score, ironically. And the high income doesn't either, although it can be a big factor, especially if you're overextended. Like let's say your reported income when you apply for credit card is $30,000 and you have $100,000 in credit lines available. Well, that's over like 3 times your yearly income. That would be like, let's say, a nation state having like 300% of their gross national product in debt, or at least for a credit card, it's potential debt. Like you have the potential to rack up that much in debt easily. So the high income doesn't affect your credit score, although it can affect your ability to get a credit card or a mortgage or an auto loan. And having higher income actually means you're more likely to get approved for a credit card, mortgage, or auto loan, even though you might not need the loan due to your high income, if you can just save the money and buy it outright. But sometimes it's a good idea to buy a house on credit with a mortgage, or a car on credit with an auto loan, because the interest rate is really low and it helps build your credit. Or even if you have a lot of credit cards, it builds your mix and your 100% positive on-time payment history, because you could have like a late payment, and if you have like 99.5% of your payments are on time, it won't hurt you as much as if only like 50% of your payments are on time. So if you have, let's say, 20 different trade lines and you have like a little balance every month on them and you pay it in full, then that's like 20 green marks on your credit report every month. Paying off all charges on your credit card before the statement cuts, so the statement has a 0 balance owed. This actually doesn't help your credit. You want the statement to have more than a 0 balance owed, for what I just talked about with the good like check marks that you paid it on time. If the balance is 0, that's bad. So you should always leave a balance on the statement, but then pay that balance off 100% of that amount within about 20 days or whatever your payment due date is, and do that each and every month. Because if you don't do that, you get on what's called what I call the interest paying track instead of the grace period track, and then all your credit charges actually start accruing interest immediately instead of not accruing interest at all. Accruing in that case means the lender, they're making money off you. You don't want them to make money off you, or at least not much money off you. They still make a little bit of money when you use your card for interchange fees. So that's the answer for that. And then if you follow along closely, you have a perfect score on my May 2018 financial literacy quiz.